In our last episode, we mentioned that we will be starting a series that will show you how you can use the wheel strategy to grow a small portfolio. If you haven't seen that episode, I strongly recommend that you check the description section of this episode for the link to that last episode. Go and watch it and then come back and continue with this one. It will give you a lot of context. And so in this episode, we will review the outcome of the trade that was executed in that last episode. And we will look at a new update on our portfolio balance based on that last trade. And then we will explore what the next trade that we will execute as part of this series of growing a small portfolio will be. If you stick around to the end of this video, we will also show you what we expect to achieve with the starting balance on this portfolio by the end of this year. All right, let's get it. As you can see from the spreadsheet we're showing here, we started last week with a portfolio size of $650. And after the analysis that we did in the market, we decided to sell a $650 put for ticker symbol LABU, and we received $11 in premium and we paid 14 cents in fees. On the 17th of February 2023, the ticker symbol LABU was trading above $6.50, and so the put contract that we sold expired because it didn't make sense for the buyer of that contract to exercise their option to sell those shares to us at $6.50 because they were trading at a higher value in the open market. And so the put contract expired worthless, which means that we pocketed the $11 less the fees, and our $650 collateral that we put down to get into this contract in case we were assigned was released back to us. And this means as at today, the 21st of February 2023, our new portfolio balance is $660.86. This represents a 1.67% return in the 4-day period that we entered into the put contract. If we go back to the charts for ticker symbol LABU, we will notice that it is still trading above the $650 mark. And as we can see here, it's closed the market at 7:59 on Friday. The market will open today. And so it makes sense for us, given how much we have in the portfolio, to sell another 650 put. And that's exactly what we're going to do. And so now we're going to look at Tastyworks to see what we can get for selling another 650 put contract on ticker symbol LABU with the money that we have in our portfolio. As you will see here on Tastyworks, we're looking at the contract period that will expire on the 3rd of March. And if we look at the put contract for $6.50, we see here that if we sell this contract, we will receive a 13-cent premium per share of ticker symbol LABU, and that means that the total amount that we will receive is $13, and the estimated credit after deduction of fees is $11.86. Actually, it should be more than that. And so this is the transaction that we will be executing today. Let's now have a look at what could happen and how this could potentially impact our portfolio after the contract expires. Before we continue, please can I invite you to like this video if you enjoy the content so far. You can also leave a question in the comment section below and we'll be sure to respond. And if you haven't done so already, please be sure to hit the subscribe button and the notification bell so that you get to see new videos as soon as they are updated on the channel. Especially now that we have this series, you don't want to miss an episode of how we're going to grow this $650 portfolio size to very, very large volumes shortly. And of course, we also ask that you please check us out on the social media channels that are shown here. We will also leave links to each one of these channels in the description section. Thank you. All right, let's get into what could happen at the end of the put contract. So we've seen that we can sell the put contract for the strike price of $6.50 for ticker symbol LABU, which will expire on the 3rd of March 2023. And for selling that contract, we expect to receive 13 cents per share. And when we think about the fact that put contracts are in multiples of 100 units of shares, we will multiply those 13 cents by 100, which should give us $13 in premium for entering into this contract. And if we anticipate another 14 cents in fees, this should translate into net proceeds of $12.86 being added to our balance. Now, what could happen on or before the 3rd of March 2023? There are two possible outcomes. Scenario number one is that the price of ticker symbol LABU is trading above the $650, and that would mean that it doesn't make sense for the buyer of the put contract we're going to sell to exercise their right to sell ticker symbol LABU to us at $650 because they can get a higher price in the open market. As such, the contract will expire worthless as it did with the last put contract, and we will have our $650 balance released back to us again, and we will pocket the $12.86 net proceeds from selling the contract. Scenario 2 is that the price of ticker symbol LABU falls below the $650 strike price that we sold this contract, in which case the buyer of the put contract will most likely exercise their right to sell their 100 shares of LABU to us, and we will be obliged to buy those shares at $650. And if that happens, it's not a bad situation. What we will then do is take on the next leg of the whale strategy, which is when you get assigned by having to buy the shares that you've sold the put for, you can then sell a call contract for the following expiration period at a price that allows you to be able to generate another premium, and hopefully you're able to sell the call contract at either $650, which is the price that you bought the shares, or maybe even a higher price that gives you additional income source to the premium that you will receive for selling those call contracts. Now let's talk about what our portfolio could look like if we're able to generate this 1.67% returns over a 1-year period. Right, let's talk about what our portfolio would look like if we were able to generate 1.67% returns every 2 weeks, just like we're anticipating with our next transaction. So we'll be looking at an annualized interest of about 43.54% return. And if we started with $650 in our portfolio and we were able to grow by 43.54%, this would mean that we would generate an additional $283 in income, and our portfolio size would be just under $1,000 in 12 months. To be sure, this amount does not factor compounding. This is assuming that we don't reinvest any of the income that is generated and we just keep that aside. So you can see that there's a huge potential here to grow this portfolio significantly by deploying the whale strategy of selling cash secured puts and then buying the stock if we're assigned, and then thereafter selling covered calls if we're assigned on the stock. Of course, as you will expect, and we will continue in this series, we will be at some point reinvesting our interest generated, the cash flow that is generated, and hopefully we'll be able to compound the amount of investment in this portfolio. So watch out for that. To be sure, nothing that is said here should be construed as financial advice. You need to do your own due diligence. We're just providing the content for entertainment purposes and also to keep us educated. Make your own choices, but join us in this journey as we take on the growth of the $650 portfolio, and let's see where we can take it up to. Thanks for watching. As always, we appreciate your subscribing to the channel if you haven't done so. And if you've subscribed and you haven't hit the notification bell, please do so you don't miss the next episode on this channel. Let's see how we can watch together to grow this portfolio size from $650 to wherever we take it. See you on the next episode. Be sure to check us out on TikTok and the other social media channels that will be shown in the description below. Take care.